This is Kerry Artak with Artak Advisory, and this is the AgriTalk video supplement for Monday afternoon show, July 26th, in which I cover three markets: October lean hogs, November soybeans, and September crude oil. Let's jump right into, before I jump into the charts, would love it if you took advantage of my 2-week free trial. If you're watching this video right now, if you've never had a free trial in my work, please, the links are all over the website, the free trial form. Just very simply, first name, last name, email address, preferably a good phone number. I will call you during the 2 weeks. We can talk the markets, talk about your hedging or trading needs. I can answer any questions you have about the work itself. There's no obligation. You don't have to give me a credit card information or anything. There's no hard sell. That's just not my style. The work sort of speaks for itself. You either take to it or you don't. And so please do the 2-week free trial. If you haven't had a free trial in at least 6 months, I offer a new free trial every 6 months. So there's that as well. Don't be afraid to jump in there once again. So let's jump into the lean hog chart. This is a weekly continuation chart of the lean hogs. It's based on volume rollover, which is a little different than your traditional rollover. Years ago, I remember in my days at the Board of Trade in Chicago, they didn't really have volume-based rollover charts. They were all traditional. In other words, presently we still have August lean hogs on the board, so to speak, but its volume has diminished in relation to October. October is the real sort of de facto front month. And so traditionally, you would have August would continue to play out on your weekly charts all the way to its last breath. In other words, when it expired and went off the board, then it was replaced by October. And now we base it on volume rollover, which includes open interest, tick volume, all these other variables that essentially follow the money, if you will. And so I think it's a more accurate form of analysis. This is a weekly continuation chart of the lean hog contract going back nearly 10 years. And this is something interesting that played out recently. This does happen with rollover. As you can see, there is a spike low here from later June when August was the front month, the lead contract. And we got a nice bounce off of this. Is a trend-defining long-term speed line projected off the 2016 low. And so long as we were trading above the speed line, the broader lean hog complex, in my opinion, was stable to bullish and even had a chance over the next 3 to 5 months that continue on up into the mid 130s, 135, this long-term structure. But when we rolled to October, which was 15 handles lower in value than the preceding August contract, we had a rollover-based sell signal, which does occur, and I do honor these, if you will. 97.60 this week. We closed 92.62 at the end of last week. And so this is our ceiling. This is the zone of resistance that can absorb buying really through the balance of October contract life, and below which the broader lean hog complex should continue south into the lower 70s. I'm giving this kind of 3 to 5 months to the downside. And so that is the big picture right now with lean hogs. Not until we close back above the 97 handle resistance do I see a cause for bullish continuation on a multi-week basis. And I'll get to that in a moment. But for right now, 97 handle resistance, able to contain buying through the balance of the year, and below which we should, over that time horizon, continue falling into the lower 70s. Let's take a look at the October contract itself. This is the October weekly bar chart. And so, what's interesting is we have 97.60 on that weekly chart, which includes a stringing together of previous contracts. And it lines up actually nicely with the recent high here in early June for the October contract, which was 97.97. So that 97.60 to 97.97 region is a ceiling really through the balance of October contract life. Now, here's the thing I'm showing you in this chart, that even if we close above the 97 handle resistance at the end of this week, which is a long shot, and I don't expect to see it, but if we did, we'd have just another week or two at the most of trade before reaching our next formidable resistance on the October chart. So the way I'm framing it with subscribers is we remain on the defensive, heavy below 97 handle resistance, 97.60. As we continue into later October contract life, we are sort of in a sell upside pullbacks dynamic below the 97 handle. And I don't really turn bullish October lean hogs unless we can get up and over this 101.20 formation. So heavy below 97 handle resistance and bullish above 101 handle resistance. If we were to close above this 101.20 formation, over the next few weeks, let's say, then quite honestly, by October expiration, we just might reach this 135 level, which would be a significant rally. But nonetheless, I think the market could, within 2 to 3 months, reach 135 even if we settle above 101.20. Until then, this is your resistance in the 97 handle, able to contain buying into October expiration. Downside, once again, the October weekly chart. 87.40 this week is a level that can contain weekly selling pressures. This formation rising gradually and honestly will change if we push higher, because it'll have to be redrawn. But right now it's 87.40 that, if tested this week, can contain selling through next week. And 87.40 is the downward pivot point into later October contract life. And so while we remain heavy and susceptible to bearish trade below that 97.60 speed line that I showed you a moment ago, we don't really turn south aggressively unless we close this week below 87.40. And then I think we have pretty much a sustained 3 to 5 week downside sell signal into the 76.50 region, where the October contract could actually bottom out into expiration. 76.50 not far off the mark of that 70.22 long-term target. Let's move on to soybeans, November soybeans. I'm going to reacquaint you with the weekly continuation chart once again that presently reflects November, but is essentially the stringing together of previous high volume contracts. I'll walk you back to November of 2020 when we had a long-term buy signal, then anticipating this 1652 half formation. This was a 3 to 5 month target, which took place in about 6 months. And this is a formation that can contain annual buying pressures, as I was telling clients at the time. And from here, we could fall all the way back into the 1120s over the following full year of activity. On the way down, I have the speed line, which I had considered to be trend defining. In other words, on the way down, I had considered this speed line able to absorb selling through summer. And once tested, we could rally back into the 1650s again within several months. But that didn't happen. As it turns out, we closed below this speed line, which is presently at 1437 and a quarter. This is our soybean resistance, our soybean ceiling, really, into autumn trade. And below 1437 and a quarter, 1129 half remains really a kind of a 2 to 3 month downside objective. So this is big picture, 1437 and a quarter ceiling, below which 1129 half remains a 2 to 3 month downside target. Let's jump into the November charts themselves. This is a November weekly bar chart. There's your 1437 and a quarter resistance. I just showed you that long-term speed line. If we close above 1437 and a quarter at the end of this week, then we actually have a bullish continuation. Now, under many circumstances, not this one, but under some circumstances, I would say closing above 1437 and a quarter, the market is gearing up for another test of 1652 half over the following 2 to 3 months. But not so fast. November has its own resistance at 1555 and a quarter. So it's stair step right now on the way up. Yeah, we're heavy below 1437 and a quarter, and we are anticipating the 1120s to the downside over the next several months. But if we close above 1437 and a quarter, I think about 2 to 3 weeks, 3 to 5 at the most, 1555 and a quarter, this rising channel top becomes the objective over that time horizon, which can contain buying into November expiration. From here, the November contract can fall back. And then, of course, closing above 1555 and a quarter at the end of any week. Once again, we have a 1652 half objective. This formation able to contain buying through next year. Yes, through next year. Now let's talk downside, given the fact that we remain heavy below 1437 and a quarter, anticipating 1129 over the next several months. This week we have decent support at 1295 half. And this very simple channel structure can contain not only weekly selling pressures, but possibly into later August. From here, we could turn back up into the 1437 and a quarter region within 3 to 5 weeks. But I'll just let you know that what I see here is if we close below 1295 half, this 1129 half 2 to 3 month downside target becomes more like 3 to 5 weeks. 1129 half, once again, this long-term channel structure that I'm terming the new floor of long-term support for the broader soybean market, can absorb selling through the balance of the year and quite possibly through next. We could test 1129 half and then rotate up into the 1650s again by summer of next year. We could trade inside this band over the next year or two of trade. Finally, crude oil, worth mentioning for heating oil. It's related to the heating oil, of course, and I know heating oil is a big component for large cattle ranching and farming operations, and hog growing operations, hog producing operations. So we're going to backtrack just a little bit here. This channel formation, 63.78, that we settled above back in May, that indicated a 2 to 3 month buy signal to this channel structure at 75.37. And I've been mentioning how 75.37 channel formation can contain annual buying pressures. And from here, the market, now that we've tested it, and we did test it late June, early July. I've been mentioning how the lower 60s, 63.78, it becomes a kind of a 1 to 2 month target. We came very close to testing this last week. We got down to 65.01, and then we bounced nicely. We could trade inside the 63.78 to 75.37 region all the way through the rest of summer. 75.37 is significant, though. From here, we could fall back even lower into the upper 40s by the end of the year, so keep that in mind. But while I'm here, I'm going to show you that if we close above 75.37 by at least a 1% margin, so adding about 75 cents to this would take us around 76.12 or so. 76.12 is a 1% violation of this long-term structure. If we close Friday at 76.12 or higher, September crude oil, then we actually have another long-term buy signal. Over the following 3 to 5 months, I would expect the market to continue into the 93 to 95 handle, this 93.39 to 95.20 region, combination longer-term channel top and long-term descending two-thirds speed line that can quite easily contain buying not only through the rest of the year, but quite possibly through next as well. Downside, remember this 63.78 formation. This is our midterm support. And we also see that on the weekly September chart itself, 62.37. So 62.37 represents the start of a range of meaningful support up to 63.78 that can absorb buying really into September expiration. I'm telling subscribers that we could trade inside the 62.37 to 75.37 region through September. We could fill this wedge out. But if one of them is to give way, it is likelier by a slim margin, but likelier that it'll be 62.37 to the downside. And if we get a settlement over the next week, 2 or 3 below 62.37, then we have ourselves bearish continuation into the 46.51 region, which is rising gradually. By the way, there's also a 5/8 Fibonacci retracement on the way down around 48 even. So the upper 40s, significant support, and becomes a kind of a, I'm going to say a 3 to 5 month target below 62.37. Now, of course, September contract will no longer exist by the time we get down here, and all the subsequent contracts, October, November, December, have similar support levels. The numbers a little different, but a similar structure to what I'm seeing here. Let's talk upside, at least near term. If we do close above 75.37 by that 1% margin, 76.12 or higher at the end of this week, then we've got a quick 2 to 3 week pop into the upper 70s, low 80s. 79.92 rises 82.27 the week of Monday, August 16th. This, as far as the September contract is concerned, is a formation that can contain buying into September expiration. From here, we could fall back to 75 handle, then support within a week, 2 or 3. And we could do this through the balance of September contract life. But just keep in mind, and I'll leave you with this image, that if we close above 75.37 at the end of any week, and this is a descending structure, by the way, so it is changing, and if we close above it by at least a 1% margin, we have a solid 3 to 5 month buy signal into the 93 to 95 handle area. And that's really all that needs to be said for this AgriTalk video supplement for Monday's show, July 26th.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You have nothing to lose and much to gain.